giving it another minute or two and seeing if we had over 100 registered, so 73 or so or 74 are online now. So we're giving it another minute, maybe 2 minutes, and we'll start the discussion. I'm sure you'll be pleased. You give me the cue, Casey. Whenever you're ready, I am.
All right. All right. Looks like it's leveling off. I think, we're about 3 minutes after. I think we can probably go ahead and kick it off.
Well, good morning, and I want to thank everybody, all the participants. We've got 77 here, over 100 registered, so hopefully that number will get up. Sometimes people have, a call or two that they're on and they've got to break away from. But Casey's been with us, so Casey Conway doesn't really need an introduction at this point, but I'm going to give a brief one. He's been with us, the Florida CCIM chapter, the last 2 consecutive Tuesdays for this Lunch and Learn presentation. It's been very enlightening, and he's got some new material, fresh meat, as he likes to call it, to present today, and we're looking forward to it. And without any further ado, I'm going to turn this over to Casey Conway. He's the Institute economist for CCIM Institute. Casey, take it away.
Great. Thanks, Terry. So we'll get right into it. So there's the cover slide. We'll advance to number 2, my disclaimer, so I don't offend anybody. There you go. I still only have $100 of net worth, but it's going down fast. I'm afraid to open my latest retirement statement. It's probably down to $25. But anyway, there's the disclaimer. We'll go on to number 3. All right. So thought we'd have make it up a little bit interesting today. So since we can't go to baseball and watch baseball, and you guys in Florida had your spring training disrupted, and I always enjoy that more than regular season, that we'd use a baseball analogy here today. So the old Abbott and Costello, who's on first, we'll use that to kind of kick off. That was my last week's weekly insight theme. So today we got some of the large bank earnings, and I'll give you my quick take as I've been watching those. So I think I've gone from disappointment to maybe disgust with the large banks. So here's the 3 big takeaways from the banks that reported: JP Morgan, Wells Fargo today. Is number 1 is that they're really just moving the pot of money around. So example, Wells Fargo, they reported 1 penny of earnings. That's because they moved 73 or 72 pennies into what's known as the allowance. They're provisioning for loan losses that they expect to come down the road. So they hadn't lost that money. They just put it in a different bucket that's protected, that's sitting there for losses. They're adding big numbers to the provisioning, which it's a little frustrating to me, because a lot of this activity that we're getting from SBA and the PPP, these are all, the banks are indemnified for making any of these type loans. We're entering this much different kind of condition than we did 2009. We don't have overbuilding. We don't have subprime mortgages. I'm not seeing that we're going to have a complete collapse in home prices and asset prices. So anyway, that's the first thing that's going on. They're moving the pot of money. They're moving it from earnings into reserves for losses. Number 2 that they've got is woe the large banks, their net interest margins. That's the spread they make between what they can borrow money overnight from the Fed or on your deposits to lending. So as interest rates at 0, of course, their net interest margin, that spread is going to contract. But what you got to remember is, it's a lot of these contracts are, 90-day to 1-year deposit contracts that weren't paying you a whole hell of a lot to begin with before this, and now they're paying you absolutely not a hell of a lot. So before you go, whoa, the large banks not making a spread on net interest margin, think about those poor retirees and whatnot in Florida and what they've not been making and what they're now not going to make. This just further pushes the retirees out of risk curve. And then the third thing is, man, are the banks making some revenues. So JP Morgan recorded record revenues for the first quarter despite everything hitting. They're making boatloads of money, trading on bonds, trading in securities. So making lots of revenue, they can squirrel a lot away into different buckets. And so when we hear from these large banks like JPM or Wells Fargo, they would only set aside 10 billion for the Paychecks program, the PPP program. I'm in the disgusted camp. I'm just grateful that we have a lot of good community banks, particularly you guys have in Florida, because the community banks are the ones that are working weekends and nights and trying to make this program work with their regulator, the FDIC. So I think the Federal Reserve and the OCC just need to have a come to Jesus meeting with the large banks and explain how this is going to work. But there's I think it was a good article on the Bank of Tampa and at least a couple of other Florida community banks that have each lent out more into the small business and triple P program than collectively Wells Fargo and Bank of America. So I'm not a real happy camper with our large banks today, and the numbers really say they're moving the pot of money around, they're making great revenues, and the woe is the banker for not making a lot of spread on his interest margin. They need to think about what's happened to the retirees. So that's my take. Johnson & Johnson was an encouraging study, J&J today. So their quarter one, they beat on their earnings by 30 cents. So it was forecast $2. It was over 2.30. They're hitting the ball out of the park. They had revenue of 26.7 billion. That was $1.2 billion above expectations. They put everybody to work. They think that their guidance was that they can have 900 million doses of a COVID-19 vaccine ready to go a year from now. So that takes care of all of us times almost two more or three more. So we can take care of us in Europe and maybe have China throw them extra 100 million left over. So J&J was very good. So tomorrow we'll get Bank of America, Citigroup. I think we'll see some of the same. We're going to get some of the airline perspectives. We'll get Delta, and we're going to get some others. So this is the beginning, and let's hope we got the disgust out of the way early with the banks. I'm not real happy with them. So why don't we go on to the next slide? Sorry, I don't have any opinions today. So again, here we go with our who's on first. I just mentioned the banks. Tomorrow and Wednesday, the next group that we get. But the second group on the right column there of this next slide, I want you to pay attention to, is what I call who's on second. The second group. So we got J&J right before here. I hadn't seen the numbers. It may come after the close on Las Vegas Sands. We'll really see how bad the hospitality casino industry. I'm expecting it's going to be worse than our worst imaginations. Tomorrow, then we'll get United Healthcare. A real interesting one to watch tomorrow is Bed Bath & Beyond. We won't get many retailers for about a month, but I think this is one to watch because the stock is already down over 77% when I put this together yesterday. But I think the online demand for home soft products with all our shelter in place could be a huge surprise. The numbers on the e-commerce products that are selling, it's right in the sweet spot of Bed Bath & Beyond. So while everybody's thrown it away, my gut tells me this could be a very positive surprise. And we're going to find out in these retail earnings who really was able to execute on e-commerce, and maybe who was doing business with somebody other than Amazon, because Amazon's really sticking the screws to the non, essential goods going through the Amazon warehouses. So those retailers that had relationships with, say, a Shopify or were turning to FedEx, they're finding that they could do their e-commerce pretty effectively, where Amazon has said, we're not restocking the warehouses with anything other than essential products that are in high demand. So Amazon's really stuck it again to the small retailer that thought they could maybe pivot to online. So those that were on Shopify, FedEx, Etsy, they're going to find, I think, that they were rewarded. Abbott Labs will be another one. Genuine Auto Parts near the end of the week will be a good one. So we're already seeing some of the impact on the automakers. So yesterday, I'm in with the University of Alabama. Toyota Mazda announced that it's not going to open the new plant they're building in Huntsville until 2021. We know Mercedes is idled. We know Honda's idled. We know Ford and GM. But we've got 3 or 4 major manufacturing brands that are idled in Alabama. We also have a big aircraft manufacturer. So I saw today where Boeing reported they had a record 150 order cancellations for their 737 MAX plane. So in Alabama at the Port of Mobile, we have Airbus down there making their A320 aircraft to compete with Boeing. And they've announced last week that they're idling that plant for at least a month. They're paying the workers. But I have more angst for, say, an Airbus. They're not an American company. Europe doesn't have the money to bail them out. So I really wonder who's going to come to the rescue of, say, an Airbus that's sitting there in Alabama. So I'm really concerned for that impact. And then we'll also get Kansas City Southern. Remember, we only have 7 Class 1 railroads. I'll view that this is one of the biggest buying opportunities to buy the railroad stocks. Kansas City Southern is the only Class 1 rail that is one of the 2 perfect T's in our railroad system. So if you think BNSF going the horizontal part of the T, and Kansas City Southern is the vertical, which goes down into Mexico. It's our only Class 1 railroad that goes into Mexico. And look at what I shared last week about Port Laredo surpassing LA and Long Beach as the busiest container port in North America. So I think Kansas City Southern, if they don't like it and they want to sell that sucker down, I'm trying to find all the jelly beans and raid all the piggy banks to buy some of these railroad stocks. But it'll be interesting to see what they tell us. So let's go to the next slide. So we found out who's on first, which is the large banks today. We know what's on second was J&J and Bed Bath & Beyond and some of the others. So what we're really struggling with is nobody really knows, who's on third and if they're going to make it home. So I'm going to try to give you a few of the things that I'm looking at that give me a good forward view of how good or bad this thing is going to get and has to play out. And I'll give you a really definitive answer on Friday in a session that I'm going to be doing at the mid-year governance meetings Friday afternoon with Eddie Blanton. So the first one I want to start with is the National Federation of Independent Businesses. They're on slide 5. So the NFIB, this was their quote, the Optimum Index fell 8.1 points, which is a huge drop. It was the largest monthly decline in the survey's history. So we're pushing all of these historical markers, and 9 of the 10 index components declined. So I got a little arrow pointing down to the one that was green, and it's not a good thing to be green, and that is increase in inventory. So this shows you that those retailers that can't sell goods, their inventories are piling up. Those that are consumer staples, they're restocking as fast as they can, bringing it in from wherever they can. So we really need to pay attention to that, but all the other indices were pretty negative. You can see the chart down there at the bottom. So this was the first under 100 reading for the Trump administration since he was elected, which is pretty staggering. So we're moving back into kind of the Obama administration territory, and I think we're going to go quite a bit lower than that. We could challenge record numbers here. So there's the link below. I encourage you to follow it. It's a monthly report. It's very deep. They survey all the small businesses. They're also telling us that it won't show up in state and IRS data for months to come here, but we have probably already lost 1 in 4 small businesses in this country. That's staggering, and we're only about 6-8 weeks really into this, 6 weeks into shelter-in-place orders. So, start asking the what if we lose more than 25% of our small businesses? What if that number gets closer to 50%? What does that landscape look like? Think about what kind of work we're going to have to do in our industry to repurpose all of that commercial real estate. So I haven't cheered you up there yet. I think I just woke up on the wrong side of the bed this morning, especially when I heard the bank earnings. Let's go to slide 6, the next one. So this is one of my favorites. I've always tracked. If I got stranded on a desert island, this is the one report I'd want to have air dropped into me to keep my sanity, which would be my real-time indicators. So I'm a true weirded out economist, I guess, or an appraiser. So the latest railroad data, their April report for the March period, it was their lowest reading since they began keeping data back in 1988 on total rail cars. So big components of that were auto pieces. So we're not moving cars. That's in the second paragraph. I want to shoot you down to the lower right corner where I've got the red box around intermodal. So intermodal, they had their biggest year-over-year percentage decline since September 2009. I think we'll break that record. When you shut down global trade and you don't have things coming into the ports, like from China to LA and Long Beach, that that handle roughly about 40% of all of our containers. This is what happens. There's nothing to move on the rail. What it looks like graphically is on the left there. So you can see the 2018 peak, and then you can see the black line where we are right now. It's a really, really steep decline. But there's an interesting nugget. All of these things have a little nugget of information that I want you to put into your what if thinking cap. It's right down there at the bottom. It's called beware of a demand shock. And this is where either businesses that are not confident to reorder or to close on shipments they put in, they may cancel them, or businesses have already gone out of business. Those orders and those imports have nowhere to go. The business is already gone. And this is an item to watch, the demand shock impact. And the only place you're going to be able to really measure it is right here on the real-time traffic. And this is a really true forward look into the health of retail and look at what's going to be happening here. And it'll also predict on our manufacturing side, if we have demand shock and orders being canceled and businesses going out, and Toyota not opening its plant for a year, and Mercedes and BMW and Honda and GM and Toyota all closed for extended periods of time, we're going to have order cancellations of auto parts and whatnot. And this ripples all around the world and through our supply chain. So this is a new term. Hopefully, well, I hate that I have to bring it to you first, but demand shock is probably the first time that you may have heard this in a while. So watch for that one. That's the nugget in the latest rail data. We'll go on to the next slide. These are two I want you to really pay attention to. I know Cynthia Shelton's on there and Arnold's on, so some of you pay very close attention with your port work to the Cass Freight Index. So this is an important one that tells us what's happening with freight. So the shaded area is business inventories. And just like we saw in the NFIB report, that shaded area is going up. Inventories are building because things, particularly the consumer discretionary items, aren't selling. And the staples, we're trying to put them in because everybody's hoarding toilet paper and things that just don't make sense to me. But anyway, the line there is our sales ratio, and you can see what's happening there. And so the combined there is your inventory sales ratio. And you saw what happened back in 2009, how that spikes, nothing selling and the inventory skyrocketing. So you have this just terrible ratio. And you can see where we are right now. That inventory to sales ratio is going to deteriorate a lot. And so it's going to be interesting, is it that inventory builds or sales decline quicker that causes that ratio to change. On the left side, we don't always pay attention to what's going on with the American Truckers Association. They have a trucking tonnage index, which is very important. So even though we put a lot on the rail today with intermodal containers, the trucks are still that last mile. They're short distances. They get us into the distribution centers, and we can already see in February, we saw some increase in it because we're trying to restockpile, but this will tell us about the health of things coming into the ports and us re-inventorying the distribution centers. So I would pay attention to both of these. So you get the rail, the trucking, and then the freight, what's happening with freight in terms of being sold or inventory. So these are three. I think they'll be good, very good forward looking to go along with the TSA passenger throughput that I gave you last week to see if anybody's getting back on planes when we lift the orders. So with that, let's move on to the next slide. This is one I just loved. This is from the Visual, I think the Visual Capitalist, maybe mistaken on here. But this was a great one. Yeah, Visual Capitalist that came out in over the weekend or the end of last week. And this one, I really want you to put your what if thinking cap on. So those of you that do retail, this is going to be particularly important. So the top part of the graph shows the growth in what's selling on e-commerce. So what's number one? It's not toilet paper. It's disposable gloves. Personal protective equipment is at the top. Look, it's almost a 700% increase in disposable gloves. Look at what's number two. Bread machines, up 652%. So we're now buying more flour and yeast. We don't trust the baker. We're afraid the bakery is going to have an outbreak of coronavirus. So we're going to make our own bread. Cough medicine, obviously, if you get the cough, I've had that affect myself. Soups, things you can't get. If you can't get ground beef or other things, you might make a soup. We might be eating a little healthier grains, packaged goods. Look at weights. weights, and then if you go down to fitness goods, so fitness goods are up 170%. Weights for like weightlifting and all up 350, 300 something 7%. What I think's happening is people are saying, I can't go to the gym, so I'll order some online equipment. I know my wife ordered some new hand weights for walking. We've purchased a replacement fitness piece of equipment. When we come out of this, are we going to go back to the gym? And so those retail centers that have gyms, I think they're really going to be hit hard. So we're changing consumption behavior. The other one I would point out is dog food is up 159%. Dogs aren't really eating that much more. You know what's changing? We have record numbers in pet adoptions going on during this virus because everybody, I'm tired of, hanging around with my spouse, and we see too much of each other now, and, we don't leave to go someplace or run errands or go travel. So we're adopting pets. Record numbers of pet adoptions are occurring. And while that's good, it's kind of clearing out, pets that might otherwise be euthanized during this crisis. There's a big fear, do we get kind of a Christmas time effect where after that puppy or that kitten grows up a little bit, or we decide they chew up things too much, that we toss them out after the virus. So the correlation to dog food isn't that dogs are eating more, is that we're adopting more pets. Look at the bottom, what we're not buying: luggage, briefcases, forget the bridal wear. No, nobody. I mean, I've got two daughters, 19 and 24. You know, I think they've given up on marriage and probably getting a job after this crisis. Swimwear, we can't go to the beach, we can't go to the pool, we can't socialize. So who would be out buying any kind of swimwear? Golf clubs. I know from my wife's standpoint, the list of to-do things that I've got that she discovers every day around the house, being closer to it, there's no chance I'm ever getting back on the golf course with the list that she's got. And I think the reason to look at this and to track this from a source like Visual Capitalist, what does this mean for the future of retail? What are we going to sell? What type of stores are we going to see? Ask yourself what it means, for example, for experiential retail. That was the hot category going into this. Now with social distancing, is it a behavior that we adopt? And now we don't want to congregate in the same degree of experiential stuff, or there's places that we do go that we want it spaced out more. So we may find those tenants want more square footage, but they don't want to pay more rent. So what is that going to mean for the rent equation and the occupancy cost equation when experiential retail says the only way I can operate now, I need more square footage for more social distancing, but I can't pay you any more rent. And that trickles through into the valuation side. If I've got the same total rent, but double the square footage, my rent per square foot goes down, my NOI goes down, my cap rate, so it doesn't change. I still have a destruction in the value there. So this is a really important one to do some what if thinking. Those of you that do retail and have retail clients, retail centers, I'd really be sitting down with this type of stuff and doing what if thinking. I don't project that we're going to see disposable gloves stay the #1 e-commerce item in perpetuity. But I think there's some things going on here that relate to like gyms and weights and fitness equipment that are going to tell us something different there. And luggage, I'm not anxious to get back on an airplane anytime. I was doing too many flights a year anyway. And if this gets me off those, I'm happy. So why don't we go on to the next slide? Wow, we got to Q&A quickly here today. So I guess I got my rant done early. It looks like we ended up with over 111 participants. We got a few chat things going on, but I don't know if any questions. Terry, why don't we open it up? This is for you. Earnings take more speed here. There's nuggets in all of these. Of course, everybody, even Johnson & Johnson, guided their earnings, their forward look downward. They're going to be a little more cautious. But we need to start connecting the dots. The Winston Churchill quote that I gave you last week, that God didn't give human beings the ability to forecast because he knew we just couldn't handle it. So where do we look? What are some of the resources we look to go forward looking? So I tried to give you a few fresh ones here today. I didn't want to give you all of my secret sauce for Friday, but why don't we stop here, Terry, and see if we have anybody that wants to be bold enough. I guess there's maybe one.
Absolutely. And there's some excellent questions already up there. We have 110 participants. I want to thank all of you for being on board. And you can see we have a lot of relevant material, but we have a great question from Todd Reinhardt. He wants to know, Casey, what your thoughts are on the final outcome of the PPP program. We know it's plagued with a lot of problems. The forgiveness portion appears to be the biggest challenge for banks. Do you anticipate a large number of defaults?
So I think we're going to see um, yes on the defaults, and I think yes on some hanky panky. And does everybody use the funds for what they're supposed to do on primarily paycheck support? I think we're going to see that there just wasn't the time to build in the infrastructure that we needed. So in the bank's defense, they were asked to do something in days, hours to days, what might take months to set up. So I get that. But when community banks can figure this out and really process, one community bank, Bank of Tampa has processed more than I believe the numbers I saw on Bank of America. That's just outrageous. These banks do not, the large banks do not want to deploy resources and participate in this. It takes them away from other activities. They're making a boatload of money in the bond business, in the trading business. They're working and want resources dedicated to their private wealth clients. Their lenders, they don't want them detracted learning, how the intricacies of this one-time program work. They just don't want to participate. When Wells Fargo says we're only going to do up to $10 billion, and unless you do something for us or let us out of our penalty box, we're just not going to play ball. I think that's when you get what I put in a post this morning on LinkedIn. It's time to have a come to Jesus meeting with the big banks. When they were in trouble in 2009, we all breathed deep, held our nose, and took care of them, and we didn't see a lot of trickle down. And I really do not have a kindness or a tolerance or a patience or mixed words for the large banks right now. And I would distinguish that from your community banks. I would tell you, if you're having trouble on the Triple P program, contact a local community bank. Even look at a credit union that is FDIC insured. The FDIC is really sat down and is providing the information and support for they're the primary regulator for our community banks and our credit unions, and they're doing a good job helping support them and work through the maze here. The other thing is your community banks. I have 3 neighbors that are all community bankers at pretty high levels, and they're working at night. They're working on the weekends. They're calling me on questions, on interpreting stuff. I'm on calls with the regulators. They're making the effort to get it done, and the large banks aren't. But here's the bottom line. In these programs, the way they're set up, the banks are indemnified. So even if it goes bad and it gets screwed up and we have wasted funds or whatnot, the banks need to get off their butts and put the credit approval people in the penalty box and understand there's an indemnification here for the banks. And there's no reason to not be processing these and being so slow, other than the banks don't want to participate. The large ones don't want to deploy other valuable resources into this program area, and they're letting the burden fall on the community banks and really the FDIC. It's not acceptable. So, answer your question, yes, I do see defaults, and I do see the forensics on this in the Inspector General's office saying, well, there'll be a lot of criticism a year, 2 years from now about the fraud and things that happened, but we had to get this up. Can you imagine if we took another week or two to try to structure all this in place? We're already looking at double to triple the number of weeks to get this stuff out, and then we're going to be out of money by probably the end of this week and need another 250 billion. And you honestly think Congress is going to come back after their recess with the election season getting in full gear and in the various conventions, party conventions this summer, July and August? You think they're really going to come back and work collectively in a greatest generation? I'm not optimistic at all. So if that helps, that's a little bit of like I said, I think I got up on the wrong side of the bed today. Sorry about that, Terry.
No, that's all right. We've got a number of questions, Casey, that are coming in on office demand. And so Adam Palmer and others are asking, what are the long-term effects that you anticipate for professional office demand?
So I'm very contrarian on this, on the optimistic side. From having been at home and my wife been at home and us doing online remote learning with kids and college kids back, I can't pray that the day comes soon enough that I can go back to an office. I think that the Americans the workforce are going to come out of this with a new appreciation for the value of having an office to go to. It's great to be at home and spend more time with family, but the pendulum swings back. And my projection is that when this thing lifts and we're able to go back to work, we are going to see a surge in office leasing activity. But here's the challenge. It's going to be just like retail. Are we going to accept the same configuration of office space with high density cubicles and open space, creative space designs? I think that may change quite a bit. And the challenge is going to be, that we want distancing in our office space. I hope we don't have to tear out all the restrooms and have six feet in between every stall and sink as we go forward. But I think that people are going to come out of this valuing having a place to go work. I think the design and configuration of office is going to change, and we may find that we take out some of the cubicles and we create more distance. I think there are going to be demands on tenants for upgraded HVAC systems or HEPA filters in their space areas. So I think from the property management, there's going to be things that we're going to be addressing in, touchless entry, handles into our space, adjustments in HVAC for HEPA filters. And I think the design and layout is going to go away from this open creative and high density kind of cubicle environments to a lower density of those. So where we were getting down to one worker per 10 square feet of office space, of course I'm exaggerating, but we went from 1 to 300 down to something below 1 per 150 square feet. That may go back up to 200 or 250 or 300 square feet. So I'm optimistic that office is going to be a beneficiary from demand, but the design, just like retail, experiential retail, restaurants, they're all going to have to cut capacity and probably have more social distancing and layout than what we were accustomed to, just from the psychological effect here. And I don't think it goes away when we lift the orders. I think it stays with us for really, 1, 2, 3 or more years. And hopefully we don't have another virus. It could go back over a 5-year period. But I think every property type is going to see that they want things spaced out more distancing and everything, less capacity and density in the space, which means more square footage, but I don't think the tenants are going to pay more total rent. Does that help?
Yeah, very helpful, Casey. I get quite a few questions on copies of the video and the PowerPoint slides. Yes, the presentation is being recorded. It will be made available to all of you. So that will be available, but I want to move on to the questions for Casey. And one other comment in that regard, that the SBA began today at 11 o'clock a series of webinars, and they have the two programs, the Paycheck Protection Program, and they have what they call the EIDL, the Economic Injury Disaster Loan Program. And the webinars began at 11 a.m. today, but they'll continue today and tomorrow. Get on that SBA site. Maybe there'll be some clarity in these webinars. I've not attended one because the first one was today at 9 a.m. And I wasn't available. I didn't get this email till later. But there is going to be some help out here explaining some of these programs, so take advantage of that. But I wanted to move on to another question that I think is really, really a relevant question, Casey, coming in from Y. Harris. And they want to know, where do you see the market around June and July? And I know we talk about prognosticating. If I were good at it, I'd be at the racetrack and not here online. But will there be another downturn, or has a market hit the bottom already?
Yeah, that's the $100 question. That's the elephant in the elevator, right? That we want to know. So here's my best looking forward. So I've shared with you all the things I'm looking at. The TSA passenger throughput. I'm looking at the port statistics. I'm looking that LA Long Beach ports aren't still open yet, and they've got 80 container vessels coming from China, and we don't know what's going to happen in California. We see Port Laredo overtaking it. We see NFIB, the numbers on small business, which is 2/3 of our economy, and a quarter of that is gone. It's already gone. We just don't have the numbers at the state level and the IRS numbers to show it yet. And I think that number could go as high as 50% of small businesses if we don't get our act together pretty quickly. And we're going to need more stimulus here, or rescue, whatever you want to call it. The 5 trillion we spent the last 6 weeks, really the last month, try doubling that. Our total debt is going to skyrocket from $23 trillion that we went into this year at, to try 30 or 35 trillion. I am not optimistic that we're going to have a full opening of the economy by June. I think we're going to have a phased opening of the economy over the summer, and that we're going to continue to have these hot spots, and until we can get enough testing capability up to do everywhere, until we honestly probably have a vaccine, which isn't this year. It doesn't look like that at all. Until we can get some, broader range acceptance around the efficacy of, the malaria drugs and the mixtures. Although they appear highly effective, the medical community wants more blind control testing to make it widespread for all the side effects. So I think what we're likely to see is maybe a limited opening of the economy by Memorial Day, and not a broad one across the country. I think that means that airports stay pretty idle, the airplane industry stays idled. I think we can get some manufacturing going, but the manufacturing we want and are used to, like making cars, is going to be very constrained for a longer period of time. So how do we repurpose those factories? Well, we're learning we don't need ventilators, that the modeling that was done out of the London and European models grossly overestimated what we needed, but we do need personal protective equipment. We need other things, pharmaceuticals, all of that type stuff. So my best guess is I don't want to give the whole answer away, because I do have a very definitive answer for Friday, but I'll give you your homework assignment. Here's the various types of recessions we can have. The nicest one is a V one. That's what everybody hopes we have: a really steep decline and a really steep recovery. I don't think we're going to get a V type recession and spike right back. The next one is you can get kind of like a U, which is you go down and you stay on the bottom for an extended period of time before you come back. That's kind of what we went through in the energy era, the 1970s, with the inflation that extended into the 80s, and it took Reagan to figure out how to get interest rates down from Volcker from 21% down. It was years that took us to get. That was a U. There's an L one. That's Japan. It went down and it never came back. Japan has never really come back. There's demographic issues. There's all kinds of issues in Japan. But that's an L1. The W is really where you have a double dip. So we have a steep drop down. We have some sort of recovery, like if we partially open the economy. But then when we discover that we can't open it all up and there's holes that we didn't plug, like the airline industries and automobile manufacturing and small businesses, we slip back into a second recession that requires more stimulus. And then I'll give you the last one. Probably none of you have heard of a Q-shaped recession. And you have to come to Friday's mid-year meeting in the town hall that I'm doing with Eddie Blanton to understand what a Q recession is and what I'm forecasting. But I don't see us back up and running this summer. I think it's a partial opening up and removing shelter in place, but I think we have a long ways to go here. I'll give you my 2 anecdotes that tell me there's more optimism and likelihood that we get going by, say, the fall. So what we're hoping for in June, July, I think comes in October, November. The first one is I have entities right now that are offering to book me and pay my honorarium today up front for doing events in October and November. They're that optimistic we're going to be there. They're willing to risk honorarium fees right now. The second one, when they booked that we're going to have the Masters golf tournament in November here in Augusta, Georgia, that tells me there's a lot of optimism. We're going to see how good those greenskeepers are at getting the azaleas to bloom again in the fall, or we're going to discover if pine trees actually change their needle colors in the fall at Augusta just for this one event. There's more pine trees than there are hardwoods at Augusta National, if you've ever been there. So those events give me some hope, but I want you to think about this summer and think of what we've destroyed in this economy so far. And there's some really interesting slides and things I'm going to talk about with Eddie on Friday. So one is I want you to pay very close attention to the fiscal in our debt situation. And then we're not done. So we got a lot more to go. What's the value of our dollar? And everybody keeps forecasting that we have no inflation. Inflation comes from two primary root causes. One is the price of goods. So if you have a shortage and the prices go way up, so we had in the 70s, we had an oil shock, we had oil prices, go from, 20, 30 cents a gallon to over $1 in a short period of time. We had massive inflation that bled through the oil economy. Volcker had to shut it down. The other one is the value of your currency. We're going to talk about this on Friday. And I've talked a little bit about what are fiat currencies. All of our is a currency that has nothing backing its value. That's what we are. All the economies in the world today, we have fiat currencies, nothing's backing our currency. And if you just print money, sooner or later people figure out your currency isn't worth anything. This is what's happened in Brazil and Latin America, where they just print money and their currency has no value, so prices go way up because the currency doesn't mean anything. So you almost go to a bartering system. We need to be very careful what we do, what the Fed and Treasury are doing, because they've just turned the printing presses on 24/7 to take on all the work that Congress isn't doing to provide some level of support. And we are a fiat currency. We're to a point where our debt levels are unsustainable. So are Europe's. Only China and Asia probably can endure this kind of fiscal stimulus because they didn't have the 100% plus GDP or debt to GDP going into this thing. So we can get huge inflation because our currency is devalued to nothing. And in fact, the way you get rid of massive debt is you have hyperinflation and you devalue the debt and the currency. I'm worried we're not looking and thinking and connecting that dot. And so here's the message I give you to take away. Do you want to hold cash right now? Do you want to hold paper assets, or do you want to hold a tangible asset where the replacement cost is a lot more, like commercial real estate? Commercial real estate is one of your pure hedges, or even a house residential, or one of your pure hedges from what I'm concerned about, because that asset can't be replaced for the same currency amount. Replacement cost is up. Even though materials have supposedly gone down, we're seeing some that haven't gone down. So I think you want to hold a tangible asset. And that's why gold prices are starting to go back up. And I think that's why I think that overall, commercial real estate assets do have a floor. I think housing is not going to get decimated like it did in 2009. We still have more household formation and demand on it. But other assets that are particularly concentrated in retail, I think get hurt. Hotel get hurt. But I'll share with you on Friday some secret sauce ideas. I would encourage you all, as your homework assignment for Friday, go back and reread our adaptive reuse paper that we published a year and a half ago. I'll just say we might have some conversation about adaptive reuse going forward.
Great answer, Casey, and I love the optimism on commercial real estate, and I, for one, believe it's real. I've got a big part of my portfolio in real estate, and you could grab a handful of that dirt and know that you own it, and that's a comforting thing, I think, for the long term. We've got a really good question from Rick Harris, KC, and he wants to know, what sector do you see as the best real estate sector for investors in the short term and also in the long term?
So I've been bullish on industrial for a long, long time. Cynthia knows me from my Colliers days and the work that I did there and what was happening in the Panama Canal. So here's what I caution on the industrial. So I like industrial. Deals are still getting done. I'm on a board of directors for a public REIT. We're closing deals. We just closed a deal the end of March in Columbus, Ohio, a fairly big deal. If you've heard Prologis' CEO on Kramer last week and how optimistic he was, and the statistic he gave that over 2% of all the world's GDP goes through one of their warehouses. But here's what I think is going to be different. Many of you will remember back in 2009, I was at the New York Fed when CMBS shut down completely. Geithner left and went to the Obama administration. So I got the first round of my gray hair and thinning during that 2 years that followed. But when CMBS shut down, we had to recreate it. And the CMBS issuance that was post that period of time is generally known as CMBS 2.0. It has some structural differences and things that we learned from CMBS 1.0 that we had to fix. I think we're going to see logistics 2.0. And here's some of the things I think will happen. The demand for warehouses and distribution centers and our logistics infrastructure is going to change. It's going to be less West Coast concentric in LA and Long Beach because we're going to onshore a lot more manufacturing. We're not going to take everything back from China, but we're going to move a lot back here. A lot of that's going to be in what I've described as the Golden Triangle, which is the Great Lakes down to Texas and Florida in the Southeast and Mid-Atlantic. So that's one thing, and that's why Port Laredo has just surpassed LA Long Beach. It's that connectivity to Mexico and the Mexico ports, the labor. It's a much friendlier region and political structure than, say, Asia. The second thing that's going to happen, I think we could see the end of these big 1 million square foot e-commerce centers that we're going to shrink the box. Go walk, next time you're going to the grocery store, walk down the grocery aisle at the grocery store, walk down the cereal aisle at the grocery store. What you see in cereal packaging is what we're going to see in industrial. It's not all going to be biggie size, family size cereal. It's going to be a lot of different size packaging all the way down to the little individual boxes you take on a camping trip or something like that, that are individual servings. We're going to get it closer to the customer. We're going to have it such that if something happens in a big warehouse, it's in really a smaller one, a 200,000 square footer rather than 1 million. That doesn't have the same disruptive effect that's happened to Amazon, where they're now having to use fogging technology to decontaminate the warehouses and the boxes going through there. So I think we're going to see the logistics infrastructure change, and the importance for you guys in Florida, the importance of your ports is going to probably, this is going to be the strongest time for you ever. And I've spoken before when I was down in Miami in January. We talked about the importance of Central Florida and Winter Haven, Plant City. That is the new inland empire in Florida from California. And you can draw up from Miami, you can draw down from Jacksonville, you can draw in from Tampa, you can distribute throughout really the whole state of Florida. And you're going to see, you've seen a different sizing in boxes. Home Depot is using, say, Port Everglades to bring all of its goods in to Florida rather than the paths they used to use. So we're going to see those channels completely change. The one thing that won't, stay close to the railroads, the 7 Class 1 railroads, and stay close to the developing or emerging inland ports. So these inland ports are how we take a fire hose at the port and we put a bigger hose to it, we get it off real quickly, and we move it inland to break it down. And that's really what's happened in Lakeland and Winter Haven. So I'm most bullish on the industrial. I think on the multifamily, the workforce multifamily, I'm optimistic about, because I think we're going to have all of these forbearance programs from the borrower and the property owner down to the tenant. But what I'm really anxious about on multifamily is the student housing. And I think on the retail could be a surprise if you understand adaptive reuse. We're going to put telemedicine in retail places, like maybe a branch bank that has a drive-through, has a vault for pharmacy. We've got to really think outside the box. I think retail is going to go back and be more in favor of consumer staples and less about consumer discretionary, because we've learned through this crisis how to do everything online. There's nothing we can't order. I mean, we figured out how to do pet food and groceries and all of that type of stuff. So I think, retail on the discretionary side. And then I think the other one, I don't even want to begin to venture what we do on the hotel side. It's going to be a real tough puzzle. I think single family comes through it fine. We had a shortage of single family. We had in most markets less than 2-3 months of inventory. We saw days on the market at record low numbers. And you think about it, it's not just the days why it's being listed, it's all the way through the closing process. If you think we were getting down to 40 days or so in terms of days on the market from the time that someone found your house, put it under contract, did the due diligence, and closed, that's phenomenal. So none of that's going to change. We still have an aging population. It's going to be interesting to see what happens to senior housing. So you guys have a fair amount of that in Florida. Do the baby boom kids have the capital after this to let mom and dad stay in senior housing, assisted living, or do we have to bring them home because of the wealth destruction? Do we also find that grandma and grandpa don't ever want to be left in a situation where they're essentially isolated and can't meet family and friends, that they may say, I got through it, get me the hell out of here, I'll isolate at someone's home, but I'm not going to do this place. We're going to see senior housing go through, senior housing 2.0 or 3. I think it's already gone through 2.0 a couple of times. So 3.0 or 4.0. So who did I leave out? I think land is going to be very interesting. Um, it's tough to get it entitled. It's tough to do all the agriculture that we want. And as we bring manufacturing back, I think there's going to be more demand for land to do industrial, to do logistics, to do housing. And the last one I'll leave you with, to think through Friday. Think about, as we went into this COVID virus, everything was moving to the city. It was all moving urban. Does it stay that way, high density, all gathered together? Or do we do like after World War II and we all go to the suburbs? Could this be the reincarnation of the suburbs because of this virus? Those are all things I think we got to be doing what if thinking about. So I'll stop there.
Yeah, great answer, Casey. I have one final question, I think, for you, and it's an interesting question to consider, and it comes in from Ed Bowen. He wants to know, could retail and or triple net types of real estate morph into the use of flex warehouse as the end game for the last mile?
Absolutely. We started to see this. Think of what Amazon was doing with Toys R Us. They were buying Toys R Us for last mile distribution. We saw that there was such a shortage to do last mile distribution in New York. People were paying insane prices for old junk warehouses out near LaGuardia Airport. Over $100 a square foot was one I talked about in May. I think a lot of our retail is close to that customer. It's again another breakdown. Do we need everything in a 1 million square foot e-commerce facility 30, 40 miles outside the city? Or are we better off having a couple of 200,000 square footers in an MSA's region, and we really break it all down and we store it kind of like we do containers? Most of our inventory today isn't in warehouses. It's on shipping containers that are on ships, they're on railroad cars, and they're on trucks. We went to that just-in-time kind of model on everything. And I think absolutely, that's why I said, read the adaptive reuse paper. There is tremendous opportunity for our retail to basically become more warehouse or last mile. That is really good stuff. I think there's also tremendous opportunity for it to be telemedicine, anything that has drive-through, where you have retail centers that may become less experiential and more telemedicine. So I think absolutely they're good locations, and you can buy them for next to nothing. I mean, you're looking at under $50 a square foot for something that costs $200 or $300 a square foot to build, and you can do last mile fulfillment. I'll give you one last example. Kroger was already partnering with Rite Aid or CVS to basically do your online grocery in your neighborhood drugstore. So they put the non-perishable stuff in a department store at a mall, and they sorted it, and they brought that box to your neighborhood drugstore, and you picked out your perishable items and picked up your non-perishable box there. So Kroger was going a totally different model, doing exactly what you're talking about, and basically using or reusing, repurposing retail for more of a flex or last mile fulfillment. So I think you're absolutely spot on.
Casey, a lot of people probably want to know about your Friday presentation and what time that presentation is scheduled for.
Yes, so it's 3:30 Eastern time on Friday. It'll be an hour. It's going to be more of a town hall where Eddie Blanton and I are going to discuss. We're going to try to get through 18 topics in 1 hour. We're going to try to keep it to only about 10 slides like this. And we're going to cover everything, and I'm going to have no shortage of opinions. And Eddie has no shortage of questions. We've been trying to collect all these thoughts and little good questions like you guys have been having here, and we're going to cover it all. The one thing I would encourage you all to do is think about what the CCIM Institute has done for you the last 2 years and the last 2 months. So the last 2 years started with Dave Wilson and then carried on with Barbara Crane and reinforced with Greg Fine as the CEO, and then carried on with Eddie this year. This Insight series where we've try to do 3 papers a year. We've taken on topics like Amazon site selection. Site selection is going to become very important again after this, especially when we reshore manufacturing. Adaptive reuse, retail evolution. We've laid the foundation for topics and really dissecting those that lay a good foundation for something like this, where we have a major dislocation or disruption. These are the things that we're going to need to know. Retail isn't apocalyptic, it's evolution. I think I was mad that I saw somebody resurrected the apocalyptic term this last week, and I barked back, no, it's going to be more evolution. And if you can talk to your clients, your borrowers, your buyers about retail as how it's going to evolve rather than be destroyed and apocalyptic, I think you'll do more business. But I would reread the adaptive reuse. I'd reread the retail evolution. It's going to be very relevant to what Eddie and I talk about. And the last thing I would do is encourage you to look at all of the letters and some of the stuff that the Institute has engaged with, whether it's NAR or IRM or the Appraisal Institute, on all these major issues that are relevant to you and your membership, whether it's making sure we get who's an essential service defined so you can go out and work and not get arrested, especially if you go to West Virginia or Kentucky or right now Michigan. The governor's just gone totally crazy there. Look at things like 1031 exchange. 2 weeks ago, we couldn't get it on the radar screen. And in 2 weeks, between NAR and the CCIM Institute and the Appraisal Institute, they got to the governors associations, they got to the Fed, they got that issue on the radar screen. I don't think we got a long enough extension, but we got one done. The value, I'm in one, I'm at MAI, I'm at CRE, I pay all these dues, I get NAR, I wonder if I get my money's worth. And I gripe a lot over the last 10 or 15 years, whether they did enough for me and the value of my memberships. And I will tell you, I feel like I've gotten the value out of all my dues and my membership the last 2 months. Your leadership, combined with this cross-pollination attitude, has clicked. I wish we could get it to pass on to Congress, but they've connected. Every one of our industry organizations are communicating, they're cross-pollinating, they're working together, they're rolling their sleeves up, they're listening to the issues that you raise, and they're in front of it, whether it's the governors, Fed district banks, Treasury, the FDIC, Congress, mayors, they're on it getting these issues addressed. So those are my 2 homework assignments. And I would tell you, I personally feel in the last 20 years of my career, I got all the value of my dues in the last 2 months for what all our industry organizations have done for us. We'd be dead without it.
Yeah, and I agree wholeheartedly with that assessment. Casey, I want to thank you once again for another riveting presentation. We still have 100 participants online, glued to every word, hanging on to the optimism that you're expressing, and really giving us some thoughts for the future, because we certainly will have to adapt. We look forward to your Friday presentation and wish you a lot of luck. And I urge everybody who's online still to not only attend your presentation on Friday, but to participate in the mid-year meetings at the Institute, which are all now scheduled online. Go to CCIM Institute and register for the meetings, and make sure we attend the 3:30 presentation by Casey Conway. Thanks so much, Casey.
I appreciate. Yeah, one last thing, Terry. Do you want to remind them about next week?
Yeah.
So we're not gonna do one of these next Tuesday because of the proximity to the Friday one, and I'll be out of secret sauce information. So I need to retool or reload. So we're gonna skip next week if that's okay, and then we'll have a lot more earnings, and I think Congress will be back in session to screw things up again. So we'll have a lot to talk about. The next 250 billion. So if y'all can deal with that, live for Friday, and then we'll skip next Tuesday, but then we'll join in the following one if this is still valuable to you.
Great, and thank you for that reminder. But we may still do something on Tuesday, but it won't be with Casey Conway. So tune in to your emails, and we'll see what happens a week from now. Thanks so much for participating.
Thank you, everybody. Good luck. See you Friday.